Okay, we're going to talk about private equity now, and I'd like to welcome to the stage our three speakers. We have the Global Head of Mining from Allen & Overy, Mr. Jeff Simpson. We have a partner at Pack Road Capital, Mike Sturzacker, and the principal at Tembo Capital, Mr. Peter Ruxton. So, gentlemen, can you come to the stage, please? Can I have a round of applause for our panellists, please? Fantastic. Okay, well, we'd like to just start off by asking you all, how's it been? How's 2017 been for you with your sort of private equity funds, and how is 2018 looking? What's getting you excited, and what are you working on at the moment? So, should we start down the end there, Peter?
Well, good afternoon. Good afternoon. Yeah, look, it's been a busy year, 17. We executed, I think, 3 deals in 17. Putting away around about 60 million, and a number of follow-on deals as well. I think most of you are obviously very aware that the market has picked up. We can see the level of confidence buoying. We tend to see more opportunities then because people are starting to spend the money in the ground again. There's starting to be new discoveries coming in, not just some of the stuff that was around during the bottom of the cycle. So quite a busy year for Tembo.
And what proportion of your deals have been new money, and what proportion have been follow-on money?
Well, for us, one of our key mode of operandi is to follow on. So we're a 10-year fund, and our view is that we don't particularly necessarily want to swamp the company at the beginning. So we will put in, the company puts a budget up for the year or 2 years or whatever it is. We look at that budget and we say, right, okay, Tembo will fund half of it or part of it. And then the next time the company's looking for money, they come again and we'll follow our rights. And so we can do about half and half. It can be more than half and half. But generally speaking, for our first fund, we did 130 million US was the size of the fund. We did 6 deals. We've now put away about 115 of that 130.
Fantastic. And do you want to tell us about anything you're proud of as successes in this year? I think we were talking outside. Hero, was that one of them, and Orion Minerals you mentioned?
Yeah, we've had one really good success, which is a company called Ero Copper.
Ero.
ERO. It's a Brazilian copper play. It's a Vancouver-based management team, TSX listed. Basically, the mine was flooded. It's been operating for 35 years. The mine was flooded by a freak event. They put a raise bore, forgot to plug the raise bore properly, and in comes the water. And there were 5 Brazilian shareholders, and they basically walked away from the mine and left 256 million of debt there, took the thing into administration. So a Vancouver-based management team came in, started to restructure, put 30 million of equity in, dewatered the mine. We came in for the last bit, there was another 25 raised. We came in for the last bit in March last year. We put in at $1.50. The Aero IPO'd in October at $4.50. It's now trading about $7.50. So we got 20 million in at that point. So it's quite a good deal for us. And we got in at a distressed moment, if you like. But it was quite clear that this is probably one of the best copper projects that I've seen in my 35-year career.
Fantastic. Mike, do you want to give us your thoughts on 2017, how'd it go, and 2018, what is exciting you?
Thanks, Leo. Our fund is structured very similarly to Peter's, so we're also a 10-year closed-end fund, and so we're constantly looking for new deals and at the same time monitoring the existing deals and assisting them where necessary. So last year there was pretty intense focus on follow-on investments into existing investments, and that's largely because last year we were in year 5 of the current fund, and so a couple of the investments we'd held for a while and they were beginning to track pretty nicely and then looking to grow. And we're very keen, if they've done the right thing by us the first time round, to back them again the next time they came. So people like Base Resources, Mineral Sands of Kenya made a big acquisition of another project in Madagascar, and we helped them into that. Aurelia is an ASX listed company with gold base metals mine in New South Wales, and they were wanting to do the deal next door, effectively, buying the neighbouring mine. And in terms of M&A deals, it doesn't get simpler or more logical than that when the ex-general manager of the mine wants to go back and buy the mine he used to run. So we helped them with that. And we had a couple of others. So it was a busy period. And leading into 18, I think we see that same kind of market continuing. Those same kind of growth opportunities are now around. There's more people with money than there has been for a while, and the management teams are looking pretty aggressively at growing their projects and their companies. So they're more willing to take money and embark on that path than they have been for a while. So I think it's still going to be a busy year.
So for 2018, do you expect to do more follow-on deals or new investments as well? What sort of
we probably would have another one or two to go, but it won't be as many as last year. Yeah.
Right. And Jeff, obviously with Alan and Overy, you're looking across the whole range of sectors in the PE space. How is mining comparing with the other sectors in terms of deal flow at the moment?
For us, we do quite a lot of PE work generally across all sectors. Mining's a big bit of it for us.
Hold it a bit closer.
Mining's a big bit of it for us. So sort of the bigger end, I guess we've done quite a bit of work for people like RCF, EMR. So for EMR, we help them buy Golden Grove in Western Australia, and then Labambe in Zambia off ARM and Vale. Across the sectors, A&O gathers a lot of information on the deals they do globally, so hundreds of deals around the world. And one little stat we were talking about earlier was that in the context of PE as against other buyers of our deals, PE and particularly in auction processes are getting something like 47% of those deals. So they're winning 47% of those deals across all sectors. So we're not just talking about mining, but that for us was a really interesting stat, that PE is setting itself up in a way that it's now winning those auction processes where perhaps 3 years ago, we were talking about it earlier, they're finding it quite hard to win those auction processes.
What are they doing that's different from 3 years ago?
I think there's a bunch of different, the market's moved, so the market dynamics are different. Funds are structured in different ways, so no longer is it, it's a hard and fast 5-7 years out. There are club deals, so PE firms are happy to club with industry and strategic buyers to give themselves an advantage, those sorts of things. And PE funds often are, they do deals for a living, so they do them very efficiently. For something like a competitive auction process, they can bring to bear a bunch of tactics that they've used elsewhere on that exercise, which might be a preemptive bid, it might be sending in the signed SPA with the deposit check in a preemptive scenario right up front, doing a bunch of other things, working with banks so that the financing arrangements are in place up front, all done and dusted, in a way that often industry probably can't get organised. That's a bit harsh, but it can't compete in the same way.
I mean, you mentioned, you were talking about 3 years ago, where there was a lot of money famously raised in the PE space. People were talking about, was it 5 billion, 7 billion being raised to be put into mining projects. At the time, they were all looking for distressed assets. Now that the industry is looking a lot more healthy, there's a lot fewer distressed assets around, I guess. So how does the PE sector have to evolve as we move through the market cycle? PE, I guess, traditionally has been thought of as something that benefits from the bottom of the market, but how can PE firms evolve throughout the cycle? Peter, do you want to start this one?
Yeah, so to be honest, at the bottom of the cycle, after the crash, if you like, so we're talking any time from about 2009 on to 11, 12, around about there. There were obviously, as the market crashes, there's a lot of stranded assets out there, and people are looking at those and sifting through those. I mean, they're not always a dripping roast, those types of assets, if I can put it that way. Some of them perhaps shouldn't have even been looked at in the first place. In the booms, we tend to get a bit carried away sometimes. We develop assets that perhaps the fundamentals are not as good as they should be. So that's one thing you have to be careful of, and we spend a lot of time looking through, doing a lot of due diligence and trying to find the jewels amongst all the dross, to be honest, at that time. So I think a lot of those distressed assets now are sort of fading into the background a bit. We're starting to see companies, making some quite exciting discoveries in their areas and developing projects, and we're at that point in the cycle now where the money has been raised and it's being spent in the ground. So we're seeing some projects like that, and Tembo, who tend to do early stage investing as well as later stage, so we can invest at feasibility, pre-feasibility scoping, or even the drill evaluation stage. We're seeing a few more of those types of projects come up, and some quite interesting ones too. But for us, it's all about quality. If you find a good quality asset, de-risk it, and then of course the exit's usually when the major buyers or the mid-tier wants to merge. And so the better the quality of the asset, the quicker and the easier the whole process goes. You get caught if you compromise on the quality, and then you de-risk it, you get to the end, and it's actually quite difficult to sell because nobody wants it, or it's a bit of a tricky asset, it's not quite got the right cash cost. That's when it gets hard.
Mike, what are your thoughts?
Yeah. Just before addressing the answer, just to point out that of that mooted $4 or $5 billion available for PE a couple of years ago, we should bear in mind that the biggest chunk of that was X2, which of course is now closed without having made XX2. So the number was probably never really as big as $5 billion. But as Peter said, look, without wanting to sound glib, PE makes money by its cash on cash return. So you sell for more than you pay, you made money. So what does that mean? If in this kind of market, the market we're in now, and I think we'll be in for a while, there are plenty of good businesses out there that built their mines in the last couple of years and now making extremely good cash and not yet being rewarded for that by an appropriate price in the market. So those kind of buyers are around, and as Peter says, it's what we spend all our time looking for. They're not everywhere, otherwise it'd be easy. But I think that's where some more of the focus will be. That you don't have to go out and build everything in sight. That's not necessarily the way to making money.
Why are these companies not getting rewarded though? I mean, you say they're making good cash, it's a good company. Why aren't they getting rewarded? Why do they need you guys to come along and help them out?
I wish I knew. I think part of it is still the pain of the past, that people haven't looked past that and got on top of what's really happening at some of these companies. And some of it is that you've still got a preponderance of sector-specific money backing these projects, and that money tends to be more stable through the cycle and is going to be there through good times and bad. And you need the generalists to come in, and I'm not suggesting they come in and mark everything up so it's toppy, but you need more recognition from the generalists to deploy more money into the sector, and that hasn't happened in a big way yet this cycle.
Are there any markets where we're starting to see this happening? I mean, I don't know if this is true particularly, but there's a feeling from, for example, our London conference that you're starting to see a few more generalist investors wandering around at those things. Whereas in Hong Kong, for example, it's a little bit, well, actually Hong Kong's a bad example because it's a lot of different types of there's lots of families and things like that. But maybe in New York, for example, at our event there, it's much more specialist mining investors. Whereas in London, there's a bit more. Do you think London is sort of leading the charge possibly here?
Yeah, I think it's there's several stages going on around the place. You go to Australia, and people say it's in boom time. Yes. You go to London, and I don't think we're in boom time yet. Canada's somewhere in between. You talk about graphite and cobalt, it's gone crazy. And you look at base metals, we're just beginning to start to see prices come up, and we're getting into the better part of the cycle. So it's like a 2-3 speed market, depending on the commodity and on the district. I think more so than normal, actually, when these cycles, being private equity people, we study these longer term cycles, which usually last somewhere up to 10 or 11 years. That's really why it's a 10-year closed-end fund, is you can captivate the cycle. And you change, obviously, the way you behave at different parts of the cycle. So we've been investing heavily, yes, at the bottom of the cycle, trying to pick up good assets, investing heavily. We've got ourselves set now. Market's starting to rise. Valuations, particularly this year, have picked up quite nicely, certainly in our portfolio. And now we're starting to begin to look for exits. We're actually being told by people who want to invest in us, you want exits, but actually you don't, because you don't want to exit at the bottom of the market. You want to exit closer towards the top of the market, where you'll get better value for your exit. So investing and exiting and you've got to take advantage of the cycle as it comes towards the top to get most of your exits in at that point. If you can do that, then you get a very healthy return on your fund.
It must be a very hard thing to do, though, because sometimes you're holding the money for 10 years, 5 years, 10 years. How do you pick, when you're picking a commodity, how do you pick a commodity that you know that in 10 years' time, 5 years, 10 years' time, there's going to be an exit, there's going to be buyers wanting to buy that? Do you pick particular commodities to help you do that better?
I think so, and I'll let Michael speak to that a little bit on the speciality metals. But in Tembo, we tend to stay down the middle a little bit. The normal base metals, copper, lead, zinc, and gold and silver. A few things on the outside, a bit of iron ore, bit of mineral sands, but generally down the middle. Why? Because the most competition and the most interest for exit is generally in that space. Once you start straying out into tantalums and tins and stuff like that, your exit opportunities start to reduce, and so you stick down the fairway. We particularly think at the moment, obviously, copper's a good place to be playing in. When the CEO of Codelco stands up, as he did 18 months ago, and says, we need $25 billion of capex to keep our copper production at the same level for over the next 10 years, that's music to our ears, yes? So Codelco's going this way in terms of its production. So fundamentally, although short-term people tell us copper's not that good, the supply is diminishing, the grade's dropping, and the supply is diminishing. We need more projects to fill the gap. So it's a perfect one. Zinc's another one. Zinc perhaps has a shorter time frame. We're in the middle of the zinc boom now. It's probably got another 2 or 3 years, maybe 4 to run, whereas copper's got a bit longer. So you have to try and think strategically about the metals, and particularly how the majors are thinking about it, to be honest, because or maybe even the Chinese, because they're the people that are going to be our exits at the end of the day.
Mike, do you
want some similar comments to Peter. The traditional base metals are easier because they've been around for so long, and you can be pretty confident that demand for those metals is still going to be there in 5 years, 10 years' time. And where it gets harder is some of the newer metals, like the battery metals, that have had a terrific run, but it's very, very difficult to take a 5-year view or a 10-year view on the price of cobalt, for example. The panel this morning was asked for the 1-year view, and I think the majority of them said cobalt, and I wouldn't disagree with that. But if we're going to make an investment where we think we're going to be there for roughly 5 years, and then we're going to want to sell to somebody, and they're probably going to take a 5-year view. So that means you're having to take a 10-year view, and that's pretty hard in something like cobalt. And it can be hard in some of the more industrial minerals as well, for different reasons. So I mentioned base resources earlier. That we came at that from a top-down view in 2011, where we just formed the view that this was a sector you had to have some exposure to. That prices have been too low for too long, and they had to increase. And unfortunately, we were too right, because prices doubled and tripled, and that's never good for any market. And it leads to a hangover, and it takes a while before that runs out. And that pleasingly has now run its course, and that sector is enjoying good times. But you've got to be aware also in some of those more industrial type minerals about the supply side response, from others. So if you're in gold, for example, you don't really have to worry about another big gold mine coming on and mucking up the market. But if you are in any of the battery minerals, the supply side response is going to be very, very real for you.
Even if the demand side is still going to be flying.
Exactly. So I think, again, not to pick too heavily on battery minerals, but because the demand side is, I think, very clear. We can all see that, we can all buy into that. But what you can't see as clearly is what the supply side response is going to be. And you need to be able to see both to predict the price. And you need to get the price right to make money. So over the length of time that we invest. So that's where it gets hard.
But I guess if you're a believer in the EV vehicles and renewable energy sort of story going forward, electrification story going forward, you can still invest in copper to play that story without having to invest in a battery material.
Or tier 1 nickel. Yeah.
Absolutely, and I suspect actually from the way things are going out there that the lithium companies probably don't need your money anyway. They've had plenty coming in.
Well, we've invested in copper cobalt in the DRC, and we invested principally for the copper initially, but obviously the cobalt now is taking it away. So sometimes you win by default, You
get lucky, yeah, absolutely. Jeff, just to go back to the sort of how PE should evolve throughout the cycle, are you seeing sort of deals, the structuring of deals changing as the market matures?
Yeah, yes, we are. I mean, I think they are getting more complex. So I think PE probably has a bit of an advantage where the transactions are more complex, the auctions are competitive. As far as the funds are concerned, we see a variety of different strategies, but one particular strategy, I guess, is just focus on control, focus on particular copper, gold, potash. So you see a bunch of different PE firms looking at these things in different ways, evolving their strategies. As far as the competitive auction processes are concerned, likewise, they've in the mining space, they've continued to evolve those strategies over time.
And I guess, the one you mentioned there, copper, gold and potash, I think that's EMR you've done some work with on some of their projects. We had Owen Hegarty actually in Hong Kong a couple of weeks ago at the Asia Mining Club talking about what they're doing, and yeah, he said it's those three commodities, and the exits are usually sort of China. So I guess keeping an eye on the exit as well is very important for the.
Yeah, once again, so I mean we will act for a PE fund when it's acquiring the project, and if we've done that and we've done a decent job, we'll expect to get engaged on the exit. So on the going in, on the acquisition agreement, you are thinking about the exit strategy. You know that a PE seller will want to sell the asset in a particular way, so it'll want to make sure the warranties are limited to title capacity, solvency. It's not going to want material adverse change sort of clauses, regulatory clauses, those sorts of things. There's a particular formula to the way a PE fund will want to come into an asset as far as the acquisition is concerned, and we're thinking about the exit and what the agreement's going to look like as far as the disposal is concerned, and thinking about the structure of the agreement in that way.
I bet. So you're very keen for them to, you sure you got an exit?
Correct.
Yeah. Note down.
You want to get it right up front.
Absolutely. Do we have any questions for our panel at this stage? If you have a question, stick your hand up. We'll get you a microphone. Anybody? Well, have a little think about some questions. I'll give you another chance in a sec. Have a think if you'd like something. But let's just talk about, where does PE have an advantage in the market at the moment? Where why PE? If you were an institution, if you're an LP, why would I put my money into a PE fund rather than a mutual fund?
Well, I think it's the advantage of a PE fund on your share register as a company is that you've got a long-term investor, and usually they're a supportive investor. So as long as you make, or obviously keep the relationship and try and keep the interests aligned, it should be a stable investor who's prepared to follow his rights in the financings as you go forward, and that should be supportive to the company. Now, often as you know, private equity groups ask for extra rights and board seats and things like that, and as long as you can manage to accept some of those and swallow them and work with each other, I think it is quite a good symbiotic relationship.
Mike, any thoughts?
Yeah, I think other investors should have some confidence that if a PE fund has come in onto their register, that there's been a significant amount of due diligence done at the technical and financial operating legal level. And there's also been robust discussions had with management that will ensure that board and management on the one hand and PE investor on the other are aligned. So you do get a terrific alignment of interests when PE is there.
Absolutely. Jeff, do you have any thoughts on why PE, where does PE have an advantage?
It would probably be, I guess, repeating the couple of points I made before in the context of competitive auctions and so forth. So we see PE firms doing best where the transactions are complex, so distressed situations, or they're particularly competitive, and the PE firms can bring to bear strategies that they've used on other transactions. So in those scenarios, that's where we see PE firms winning assets and eventually doing well.
And which types of, I mean, there's all sorts of different types of PE firms, different structures and everything. Which ones get the best returns for their investors, for their LPs? What should companies, PE firms do to generate the best returns? I mean, what's the optimum mix?
Look, I think it varies quite a bit. As I'm sure the audience knows, there are lots of different types of PE fund. There are those that insist on control. They buy assets. They want everything to be private, and they control basically from day one. If you like, the classic end of private equity. And then there are funds like Tembo who play across from the private into the public. Why do you have companies public? Because generally speaking, in markets like we've got now, and as we go towards the top end of the cycle, you get more value in the market than you. Whereas a couple of years ago, it's actually probably an advantage to be private rather than listed, because you get absolutely trashed in the market. So often for us, we would be quite happy to pick up a private company and then list it during our period of tenure within the company. But which make the best money? Well, it's difficult to tell. At the end of the day, I believe a lot of what creates value is obviously the project, the de-risking of good projects, discoveries obviously around the projects themselves. And if you can see some of those opportunities when you go in, I mean, that's why Tembo has a very technical team. You know, we have a team fit for purpose. We're trying to find the best assets. So we're a bunch of geologists, mining engineers, metallurgists. We try to really understand the project. We try to see projects that the majors want early, and then we spend 5 years de-risking them, and then the exit becomes very easy because the major just says, we've just got to have that, and whack, you've gone. So there's often a real value there. There is also obviously value in structuring deals. If you structure deals properly, particularly on entry in the bottom of the market, like we've seen over the last couple of years, difficult to choose the bottom of the market when you're in it. So what we've done is we've taken convertible loans in there, and we've had those convert at the share price at the time. So we've been able to come in as the market's been falling, put our money into the company. They've been able to use that, but we've been able to price it when you get to the bottom of the market, rather than being embarrassed having put the money in to try and help the company, and then the price goes down even lower. So deal structuring like that's quite important, and particularly around the exit is very important.
Yeah, I think it's the optionality that deal structuring gives you that is where you can make money if circumstances change in a way that you perhaps didn't predict or anticipate. So, for example, it's not, most private equity is not looking to just put in straight equity, but some sort of mezz finance as well can be very handy as situations unfold and move perhaps in a direction that, as I say, you didn't anticipate. So, so that is important. But I think there's no magic one for any of those, and you can say one fund's better than another because they do that better. At the end of the day, it's the project and the management team, and not necessarily in that order, that are going to make you the money.
So you want people who can pick good projects, but then also be nimble and flexible to evolve throughout the cycle to maximise value and maximise returns and the success of their business that they're investing in.
Yeah, and you have to invest with the cycle in mind. So if you're a long-term investor, you must try to read the market where we are in the cycle. I mean, I think in London they call it the Investec clock. It's actually comes from J.B. Weir and Lion Selection originally, and it's the product of Robin Widdop and his work over the years. But he's got an investment clock which basically tells you what's happening all the way around the clock. And if you can see those things happening, you know exactly where you are on the clock. And that tells you when to invest and when to exit as a private equity investor. So understanding that clock for a 10-year fund is really quite critical.
Okay.
And the key to understanding that clock is the hand doesn't move at the same speed all the way around.
Absolutely. Final 30 seconds. 2018, dry powder, how much, and what sort of types of companies are you looking for? What's getting you excited? What's going to get you most excited for 2018? Peter.
So I guess we've got another 50 coming in. So we've got quite a bit of money coming in the next month or two. We're looking probably for 3 or 4 investments during the year. Our current fund is already heavy in copper and zinc, and we're probably looking for some gold in West Africa or gold elsewhere, gold, silver. Doing a lot of work in Mexico, West Africa, quite a bit in Latin America as well at the moment. But for us, just because of what we have in our fund currently, it's probably gold, maybe a bit more copper.
Fantastic. And Mike?
Probably base metals and perhaps some industrials, or verging on industrials. But never say never is one of our mantras. And roughly about $100 million or so.
Fantastic. Okay, unfortunately, we've run out of time. So can I have a big round of applause for our panelists? Thank you very much. Right.